Rebalancing is the process of realigning the weightings of a financial asset portfolio. It involves buying and selling resources in a portfolio on a regular basis to maintain a specific or desired level of resource designation or risk. For example, the initial capital structure goal was to have half stocks and half bonds. If the stocks had fared well over the period, the portfolio's equity weighting might have been increased to 70%. The financial supporter may then sell a couple of stocks and repurchase bonds in order to achieve the portfolio's first objective distribution of 50-50. Portfolio rebalancing protects the financial backer from being unnecessarily exposed to risks. Furthermore, rebalancing ensures that the portfolio holdings remain within the risk tolerance of the management. These measures are frequently implemented to ensure that the risk level is at the appropriate level for the financial backer. As stock performance is more volatile than securities, the position of stock resources will alter in response to economic conditions. Along with the exhibition variable, financial backers may alter the overall risk in their portfolios to fulfill shifting monetary needs. Rebalancing as a word refers to the even distribution of resources. However, a 50-50 stock and bond split is not required. While there is no set schedule for rebalancing a portfolio, most plans examine classifications at least once a year. Possible to forego portfolio rebalancing. Rebalancing allows financial backers to sell high and buy cheap, taking profits from well-performing businesses and reinvesting them in areas that have not yet seen as rapid growth. Calendar rebalancing is the most basic method of rebalancing. This process entails analysing the speculative assets in the portfolio at predetermined intervals and modifying them after the first allotment at an optimal recurrence. Monthly and quarterly assessments are rarely used because rebalancing would be too expensive week after week. At the same time, a yearly approach would consider a large amount of modest portfolio float. The optimal recurrence of rebalancing is still being determined since time constraints, exchange costs, and permissible float determine it. Calendar rebalancing has a substantial advantage over more responsive solutions because it's less time-consuming and costly for the financial backer. It has fewer exchanges and does not have predetermined dates. The downside is that it does not consider rebalancing at various rates regardless of how much the market fluctuates. A more responsive approach to rebalancing revolves around the permitted percentage of a resource in a portfolio, which is known as a constant mix strategy in groups or passages. Each resource class or individual security is assigned an objective weight and a resistance range for comparison. Constant proportion portfolio insurance is the most often used advanced rebalancing approach. That's the type of portfolio insurance in which the financial backer decides on the monetary value of their portfolio and then builds resource allocation around that decision. In constant proportion portfolio insurance, the resource classes are adapted as an unsafe resource and a conventional resource of one or more money, reciprocals, or depository securities. The outcome of the CPPI approach is similar to that of acquiring an engineered considered option that does not make use of genuine choice agreements. CPPI is frequently referred to as a concave methodology rather than a concave strategy, such as a constant mix. The portions inside their retirement accounts are perhaps the most well-known areas in which financial backers try to adjust. Resource execution influences overall value, and many financial backers choose to donate more strongly when they're younger and less forcefully as they approach retirement age. When the financial backer intends to draw down the assets to offer retirement income, the portfolio is often at its most traditionalist. Depending on market performance, financial supporters may be able to locate a large number of current resources held inside a single location. Rebalancing permits the financial supporter to transfer a portion of the assets now held in stock X to another speculation, whether it be a larger quantity of stock Y or repurchasing another stock entirely. By diversifying the portfolio over multiple entities, a fall in one will be countered to some extent by the activities of the others, providing a degree of portfolio soundness. So what do you think? If you like this information, you can like and subscribe to our channel. You can also hit the bell icon to get notifications for our other videos. I'm Rachel for Kalkine Media.